Welcome to Talks and Views. In this video we will discuss risk formula, inherent risk, control effectiveness, residual risk. The compliance formula every banker should understand. Before we dive into the video, I warmly invite you to subscribe to the Talks and Views, where we share expert insights and practical knowledge on trade finance, compliance, blockchain, digital trade, and supply chain finance. Our content is specifically designed to support banking professionals, trade finance practitioners, compliance specialists, and students preparing for globally recognized certifications, including CDCS, CSDG, CITF, CSCF, ACAMS, CGSS, CCAS. Let's dive into the video now. The big compliance question. Is your customer really high risk? A customer may naturally present a high level of risk because of high-risk geography, complex ownership structure, high-value international transactions, cash-intensive business, PEP exposure, high-risk products or services. But here's the important question. What is the risk before controls? That is called inherent risk. Inherent risk equals risk that exists before applying controls. Practical example. Imagine this customer. A corporate customer. 1. Operates across 5 countries. 2. Has a complex ownership structure. 3. Conducts high-value cross-border transactions. 4. Deals with several high-risk jurisdictions. 5. Has significant international payment activity. The bank's initial assessment identifies inherent risk equals high. Why? Because the customer's business model, geography, ownership and transaction profile create significant exposure to financial crime risk. But the assessment doesn't stop here. The next question is, what controls does the bank have in place? Control measures. How does the bank reduce the risk? The bank may introduce stronger controls such as 1. Enhanced Due Diligence, EDD. 2. Verify Ultimate Beneficial Owners, UBOs. 3. More frequent KYC reviews. 4. Understand source of funds/source of wealth where appropriate. 5. Senior management approval. 6. Sanctions and PEP screening. These controls don't necessarily eliminate the risk. They mitigate the risk. This is where compliance adds value. Now calculate residual risk. What risk remains after controls? Suppose the bank assesses and found if inherent risk equals 20/25, which means the risk is in higher side. On the other hand, if residual risk equals 8/25, which means the risk is moderate. Strong control measures. EDD plus UBO verification plus monitoring plus screening plus reviews. Controls don't make risk disappear. They reduce and manage the risk to a level the institution may be prepared to accept, subject to its risk appetite and methodology. The compliance takeaway. Don't confuse these 3 concepts. 1. Inherent risk. What risk exists before controls? 2. Control measures. What are we doing to reduce and manage that risk? 3. Residual risk. What risk remains after controls are applied? The golden rule. High inherent risk is not equal to automatically high residual risk. But remember, weak controls higher residual risk. Strong controls lower residual risk. The real job of compliance isn't to pretend risk doesn't exist. It's to identify it, understand it, control it, and continuously monitor it. That's the power of a true risk-based approach. Thank you for watching this video. Like, share, and subscribe to Talks and Views, and we'll see you in our next video. If you are looking for professional training for CDCS, CSDG, CITF, ACAMS, CGSS, CCAS examinations, then you can contact Trade Hunt Management on the contact details appearing on the screen right now.